Hey everyone, happy Thursday, September 19th. It's a little bit before 10 a.m. on the West Coast, and it's time for another market update. Well, yesterday it finally happened. The Fed finally cut their Fed fund rate. First cut, I believe, since March 2020. Good news all around. So let's take a look at what happened. Like I said, yesterday they cut their rate. Going into yesterday's meeting, the only question the markets had was whether or not they would cut it a quarter point or a half a point. The markets were is 55% a half a point, 45% a quarter point going into yesterday, and they ended up cutting a half point, which was kind of a pleasant surprise. Most people, at least as late as last week, there was an 80% chance of only a quarter point. So good to see them do that. Keep in mind that Fed fund rate is not directly connected to mortgage rates. Mortgage rates did not wait. Mortgage rates have known this was coming, at least some sort of cut for quite a while. So the way mortgage rates work, it tied to bonds and treasuries and stuff, that had already kind of been built in. But overall, it's good to see the Fed being aggressive. So let's take a look real quick. Like I said, they cut their rate yesterday down to 4.875, first cut since March of 2020. As you can see over, going back to January 1995, right after they start these cuts, usually we see recessions kick in. Generally, that's because they make their cut because the economy is slowed down, employment slowed down, things like that. So it'll be interesting to see if they finally pulled off the mythical soft landing and we're not going to go into a recession here shortly. But most indicators say we could already be in one. So fingers, no one wants a recession, but just keep in mind housing tends to go well in recessions, and mortgage rates, as you can see, tend to come, or at least Fed fund rate, which is connected in some ways to the mortgage rates, tend to come down during recessions. So overall, though, a pleasant surprise. They did cut by a half a point. But the more important part usually is after the meeting, they release a graph showing kind of how many cuts they think will happen the rest of the year and going into next year. That was a little bit less than I think the markets were hoping for. And then the next important part is the Chairman Powell has a press conference about a half an hour after they make this decision. And in that press conference, he answered some questions in ways that, at least the mortgage bond market did not like. He was not concerned about employment, the labor market at all. We know that's going to be pretty closely connected to how much they cut and when they cut. He indicated that a half a point cut, we shouldn't expect this every time, which the markets were hoping maybe we'd see a couple half point cuts in a row, so we didn't like that. He did not declare a victory on inflation, and we know inflation and employment are the two things they're keeping close eyes on. So that the press conference actually wasn't something we liked actually in the mortgage bond market, even though we got that half point cut. What he said afterwards wasn't necessarily what we wanted to hear. So we'll get into that more in a second. Next thing we got this going back to last week, we got August PPI, producer price inflation. That was up a little bit more than estimated for the month, or a little bit less. And it hit 1.7% year over year, which is a 6-month low. As you can see, we'll take a quick look at a little graph. From the highs it was back in May, above 12%, down being below 2%. Good to see. Again, producer inflation is, what the cost of the people to make the goods that we're buying. So it's not as important as the consumer inflation that the Fed's paying attention to, but still important stuff. Next thing, August retail sales. Those were up more than expected. Expected to be a drop of about 0.2% for the month. They were up 0.1%. They're up 2.1% year over year, because Americans are still spending money. So, the lower this looks, if we got this number right here, things might be a little bit better, just because, kind of shows the Fed and everybody that, hey, Americans don't have as much money. We're starting to slow down our spending. But by these coming in more than expected, that wasn't necessarily the greatest thing to see. So stop spending the money, everybody. Next thing, August starts and permits. So this was a nice rebound. This is builders. This is, the new starts, the new permits, homes that are in construction and homes that are being completed. For the month, permits were up 4.9%. Starts were up 9.6%. Construction fell off a little bit, but that makes sense when you think we're getting close to the end of the summer. Some parts of the country, they're not going to be able to start construction this late in the year because they don't want to go into the winter. Things like that. So, but the permits and starts, especially permits, is our first indication of future inventory. So right now, permits are running at about 1.48 million, annual pace, where I believe, the household demand is more about 1.8, 1.9 million. So we're still, even though it seems like we're lagging behind, we're actually operating at a deficit on how many houses we're going to need in the future. So good to see that this is kicking up, but again, still more housing needed, as we can see by pricing. Next thing, August existing home sales came out this morning, down 2.5%. It was expected to be up about 1%. Not too shocking to me. August, that means these are homes that close in the month of August. So they were shopping in July, June, and rates were still, they hadn't started their move downward yet. So, that's not shocking to me that we will be down in that category. So it'll be interesting to see what September, October, and November look like, even though it's the off season, with rates coming down. Initial jobless claims. This came out this morning, expected to be about 230,000, came out 219,000. So this just backs up, Fed Chair Powell saying the labor market's fine. So, that we got to keep a close eye on this number, close eye on the BLS jobs reports, because, like as we talked about, the employment has such a big deal, has such a big effect on how the Fed looks at things. So the bigger this number is, the higher unemployment gets, things like that, the better chance we're going to get, cuts, more consistent cuts, bigger cuts, things like that. Next thing we got. So where does that leave us? So average 30-year actually went up this week. You would think we got a half point cut. Why? How did mortgage rates go up? Lots of reasons. Let's take a look at this in graph form. So this is the last year. So this point right here, this is July 26th, I think, and it is about 6.91. So around here, this is when the market started, the mortgage rates started building in this rate cut. We know there was going to be a rate cut at this meeting. We didn't know how much it was going to be at different times. Right here, they thought a half point. Then they started thinking maybe a quarter, so rates went back up. But, the mortgage rates are not directly tied to this Fed fund rate. When the Fed fund rate is cut, it doesn't mortgage rates did not go down by half a point yesterday. Like I said, they actually went up because we'd already built this stuff in. We had already made this big move down, almost a full point in less than 2 months. And like I said, we didn't really like the graph they released as far as future cuts, and we didn't like Powell's comments. Powell's comments, we wanted him to say, yeah, we're going to do another half point next, next thing, and labor market's weakening, things like that. So the reason they actually jumped yesterday after such a nice half a point cut is because mortgage rates are not connected. The trading that goes on that affects mortgage rates, they did not wait till this day when they knew this was going to happen already. So that's just an explainer. A lot of people think this is our rates when the half point happens, but like I said, we had already made this nice move down over the last couple months. So it went up a little bit over the last day or so, from 6.11 to 6.17. It'll be interesting to see how things go going forward. And these are really the important things we have to take a look at. We got 2 PCE reports and 2 BLS jobs reports. So 2 inflation and 2 big jobs reports between now and the Fed's next meeting, November 7th. So depending on how this inflation data comes out, depending on how these jobs reports comes out, that's going to affect what the Fed, what the rate cut is at this meeting. Is it a half a point? Is it a quarter point? What they say about moving forward. So these are the dates we have to keep our eye on. We have to keep our eye on these job claims. Basically anything inflation and employment related going forward, we need to keep a close eye on. But overall, it was a wonderful day. It was good to see the Fed, even though again mortgage rates didn't drop yesterday by half a point. It's still good to see they're being aggressive. They made a good move. They didn't underdo it by only doing a quarter point. So let's hope they continue that attitude at these upcoming meetings. We see rates continue to drop as we go into next year, and it stimulates more business. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, I hope everybody has a great week. Thanks, guys.